Are you planning to take out a student loan, but confused between federal and private options? You're not alone. Choosing the right type of student loan can save you thousands of dollars and years of financial stress. In this video, we'll break down everything you need to know about private versus federal student loans, what they are, how they differ, pros and cons of each, and which might be the best fit for you. Let's start with the basics. What are federal student loans? Federal student loans are loans provided by the U.S. Department of Education. These loans are funded by the federal government and are designed to help students pay for higher education expenses like tuition, books, and living costs. There are several types of federal loans, including direct subsidized loans, direct unsubsidized loans, PLUS loans, and direct consolidation loans. Subsidized loans are based on financial need. The government pays the interest while you're in school at least half time, during the grace period, and during deferment. Unsubsidized loans are not based on need, and interest starts accruing immediately, even while you're still in school. PLUS loans are for graduate students or parents of undergraduates and have higher interest rates and credit checks. Consolidation loans allow you to combine multiple federal loans into one for easier management. What are private student loans? Private student loans, on the other hand, are issued by banks, credit unions, and online lenders. These are non-government loans, and the terms vary widely depending on your credit history, income, and the lender itself. Unlike federal loans, private loans may require a co-signer and don't offer the same borrower protections or flexible repayment options. Now that you know what each loan is, let's compare them head-to-head. Interest rates. Federal student loans have fixed interest rates set by Congress. Everyone gets the same rate, regardless of credit score. This makes budgeting easier and provides long-term predictability. Private loans can have fixed or variable interest rates. The rate you receive depends on your creditworthiness or your co-signer's credit. Rates can be higher or lower than federal loans, but they can also increase over time if variable. Eligibility requirements. Federal loans are available to almost every U.S. citizen or eligible non-citizen who fills out the FAFSA form. You don't need a credit history or income to qualify for most federal loans. Private loans, however, often require good credit and steady income. Students usually need a co-signer, typically a parent or guardian, especially if they haven't built credit yet. Repayment options. Federal loans offer a variety of repayment plans, including standard, graduated, income-driven repayment, and extended plans. Some even offer loan forgiveness programs after a certain number of years, especially for public service workers. Private loans are less flexible. Repayment terms are fixed by the lender and rarely offer income-based options. You usually can't switch repayment plans after signing the loan agreement. Deferment and forbearance. Federal loans offer built-in deferment and forbearance options if you're experiencing financial hardship, unemployment, or returning to school. You can pause payments without penalties in many cases. Private lenders may offer deferment or forbearance, but it's not guaranteed and varies by lender. Interest often continues to accrue during these periods, increasing the total amount you owe. Loan forgiveness programs. Federal loans are eligible for forgiveness under several programs, including public service loan forgiveness and teacher loan forgiveness. If you qualify, you could have part or all of your loan canceled. Private loans do not offer forgiveness. You are responsible for the full balance no matter what, even in extreme situations like disability or death, unless the lender has very specific terms. Loan limits. Federal loans have annual and lifetime borrowing limits. For dependent undergraduates, the cap is generally lower, often requiring students to find other sources if costs exceed these limits. Private loans can be used to cover the full cost of attendance, including tuition, housing, books, and more, up to the school certified amount. There's typically no fixed cap, but you may not qualify for higher amounts without strong credit or a co-signer. Subsidies. One of the major benefits of federal loans, especially subsidized ones, is that the government pays your interest in certain periods. Private loans never offer this. You're on the hook for all interest from the start. Refinancing options. Federal loans can't be refinanced through the government, but you can consolidate them. However, refinancing through a private lender will cause you to lose all federal protections and benefits. Private loans can often be refinanced through the same or different private lenders, sometimes at better rates if your credit improves or your income increases. Which loan is right for you? Now comes the big question. Should you choose federal or private student loans? If you qualify for federal student loans, they should always be your first choice. They offer lower risk, more flexible repayment, and valuable protections that private loans just can't match. Private loans should only be considered when you've maxed out your federal loan eligibility and still need additional funds. Even then, compare multiple lenders to find the best rates and terms, and only borrow what you truly need. Here's a quick rule of thumb. Go federal first. Then use private loans to fill any financial gaps, but proceed with caution. Common scenarios and real-life examples. Let's take two students, Anna and Jake. Anna is a freshman going to a state university. She qualifies for subsidized federal loans and takes out $3,500 her first year. Her interest rate is fixed, and the government pays her interest while she's in school. She's eligible for an income-driven repayment plan and possible forgiveness in the future if she becomes a teacher. Jake is attending a private college with a $60,000 annual price tag. After maxing out his federal loans, he still needs $30,000. He applies for a private loan with his dad as a co-signer. His interest rate is variable and depends on market trends. There's no income-based repayment or forgiveness, but it fills the funding gap. Both loans served a purpose, but Anna has more protection and lower risk long-term. Final thoughts. Student loans are a major financial commitment. Choosing the right one can mean the difference between manageable debt and financial hardship. Federal student loans come with security, flexibility, and long-term support. Private loans offer additional funding but less safety net. The best choice depends on your situation, but understanding these differences empowers you to make the smartest possible decision for your future. If you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and turn on notifications for more personal finance tips and student loan guides. Thanks for watching, and good luck with your education journey.